Time the coronavirus has affected equities and government yields, but do investors need to worry about underlying debt? Our Steve Liesman's back at HQ taking a look at that. Hey, Steve.
Morning, Carl. Top executives at all three major credit rating agencies, Moody's, S&P, and Fitch, tell CNBC they're closely analyzing the potential effects of the coronavirus on corporate, municipal, and sovereign debt. Moody's says this is definitely something that we're monitoring very closely. S&P says there will be more ratings actions and the pace will quicken. Fitch says it hasn't downgraded any companies yet due to the virus, but it's monitoring it. S&P has changed 27 debt ratings, including 7 downgrades, and 15 companies placed on negative credit watch. Moody's, on Samsonite and on ratings watch negative. On Monday, it had earlier done the same for Sabre Corporation and Wynn Resorts. The debt's attracting the most scrutiny, some of the obvious ones. Some airlines with weaker balance sheet, other companies in travel and tourism, and countries, or the sovereign debt of countries that rely on those revenues to service their debt. Commodity companies also being watched carefully, along with countries reliant on commodity revenues. The main worry, not investment grade, but speculative grade debt, and that should raise a red flag for investors going down the credit ladder and hunting for yield. Mohammed El-Arian in a Financial Times piece this week worries that liquidity stress could be exacerbated by a lack of funds willing to cross over into junk territory, put off by sudden spikes in credit spreads and less friendly trading conditions. While spreads for some speculative debt have widened, rates have fallen, so that eased the burden on the other side on corporate cash flows for now. And some companies or countries might get relief from government programs or bailouts. But Craig Lamos-Stein, head of analytics and research at S&P, told me it's all hands on deck. We need to be proactive. We can't wait until the economic effects are already obvious. Carl and Sarah, as you know, there's a history here, and I think it's one that the rating agencies of not being all that out front on the financial crisis don't want to repeat.
Steve, have you looked at all at the credit market and how they're pricing airlines and cruise ship operators? I read in a trading note that the CDS for some of the cruise lines have started widening out.
Yes, some have started widening out. Also, you have an increase in the spreads on high yield debt as well. Look, Sarah, you remember the financial crisis. It's not that. And the reason it's not that, I think, at this point is there's still a lot of liquidity around. Of course, liquidity can dry up overnight. But right now, I mean, you need a creditor and a lender, a borrower to really have a problem. Borrowers who can't borrow, creditors who don't want to lend. We don't have that just yet. People are watching it. I think one of the things I've heard from people is that if dividend yields look really high, well, maybe the stock price needs to adjust. And if the stock price looks really low, maybe you ought to look at the underlying debt, and maybe there's a problem there. So everybody just needs to be aware of the capital structure of these companies and try to game out in a very difficult set of calculations here how all this could play to the particular company in question and their ability to service the debt.
But, Steve, there's nothing like the financial crisis, given our financial institutions then were highly levered and invested in assets that were nowhere near worth what they said they were. I mean, this is not even remotely close to that when it comes to the financial system and our banks.
I agree, David. But the trouble is what Mohammed's talking about, what the credit rating agencies are looking at as well. What if the fundamentals underlying this debt were to change and change quickly? And how do you game each one out? There's going to be credit events here, David, and I think that's really the key. Not that there's going to be a widespread financial crash or financial crisis here. That's not what the reporting shows. The reporting shows is that the firmament underneath these companies and some companies is going to change, and investors need to be aware of that.